All right, here we go. So we believe that TexAmericas Center is strategically positioned to be your next best location for setting up and operating a business. Not just us. Recently, Fox Business News and the Viewpoint with Dennis Quaid did an expose on us. This is a 1-minute video from that larger video talking about why we're a great place, Texarkana as well as TexAmericas Center.
Is there audio?
Well, there's supposed to be. If we're not getting it, then we'll just move on. That's interesting. Okay. Sorry about that. The Texarkana Advantage, a business-friendly location, access to the greatest market share within 500 miles. There's 23 major MSAs, a globally competitive operating environment. We are the low-cost MSA in Texas, known as a low-cost manufacturing location or operating location. Unmatched employee value. The cost on a per hour basis for employees runs about 20% below the U.S. average in Texarkana, and we are a labor surplus market, potentially the last one in the state of or in the United States. We're a civic and legislative support. We have strong support from the entire civic leadership around Texarkana, but most importantly, if you're needing to interact legislatively, especially at the federal level, very strong, because we bring 4 sets of state senators and then multiple congressmen to the table across the 4 states that our labor shed comes from. And, we are a community of problem solvers. Without a doubt, we work to try to address issues on behalf of not only ourselves, but our clients to keep things moving forward there. A little bit about TexAmericas Center. We were formed as a local redevelopment authority. We own 12,000 acres. We are the authority having jurisdiction over top of our property. We have the #1 certified site program in the southern United States, #3 overall for the entire U.S. As the top industrial park. And in terms of staff experience between the 4 main key people, we've got over 150 years of experience in community and economic activity. And I should probably also throw out that the Union Pacific designated us one of their focus sites, one of the places that they will refer business to. So it's a great honor to have gotten that. We are not just a normal economic development organization. We are we provide value-added services. So we're a little bit municipal entity, we're a little bit economic development organization, and we're a whole lot private sector industrial development company with some unique services. So, we have professional engineer on site to review. It kind of ties back to the AHJ. So we have the ability to remove 6 to 18 months worth of public meetings that are required when you do business with a city. We offer build to suit and build out to suit services. Third-party logistics, rail services. For international businesses, we offer soft landing activity. We also can help identify the incentives that you would be best suited to apply for. And then from a financing standpoint, we have access to new market tax credits, opportunity zone, and other loan programming. Full basket of incentives. I'm going to talk about just a handful here. Those are highlighted, but very much have a full basket of federal, state, and then local incentives. So getting to some that are most advantageous for companies looking at coming on to TexAmericas Center, we are foreign trade zone number 258. The key benefits of looking at coming on to us is that we're a cash management tool when you use a foreign trade zone. So normally you have to pay the tariffs as soon as the tariffed item enters the United States. But what a foreign trade zone does, it kind of allows you on paper to look like the items that you're importing are still sitting out in the middle of the ocean, and so therefore have not entered the U.S. commerce system. So you deflect payment of those tariffs until the item itself leaves your warehouse that's been set up to be a foreign trade zone. At that point, you will make payment. Sometimes you wind up not making any payments. So if in the process you're doing manufacturing and there's waste, scrap, or the damaged goods that you're going to return right back to where it came from, and that location is outside the United States, you pay no duties on any of that. So it becomes an incentive to be in a foreign trade zone. Now, the inverted tariff is kind of interesting because what it's saying is you're going to import this item from Israel and this item from South Korea. And the combination of the two, maybe one is 10 cents and the other one's 10 cents. And you would think that when you combine them and they leave the system, they would be 20 cents that you would pay. Well, that's not the case because of the value added aspect of attaching those two items together. It may be an entirely new tariff, which is 15 cents. So again, it's an opportunity for you to avoid making those payments when you export, or I'm sorry, when you move goods out of the foreign trade zone into the U.S. Customs Service. The other is, and these two are very closely aligned, streamlined custom procedures and inventory control and security. Both of these wind up allowing you to reduce the amount of paperwork that's involved, the number of entries, and that means a lower cost on your administrative side of things. You do have to track your foreign trade zone items in a separate tracking system, and you have to have your foreign trade zone separated through fencing, some type of secure physical uh, uh, wall, something that separates it from the rest of your inventory. Um, but that then allows you, again, to not have to do as many items in terms of reporting. The final piece is, as always, TexAmericas Center works very hard to try to help you access any and all of the incentives that are entitled to because of the type of project that you're doing. One of the things that we do is that we'll help develop an incentive letter so that you understand what incentives you're most likely to be able to access and provide you an estimate on the benefit of those. So that's the foreign trade zone. So the next would be new market tax credits. So new market tax credit also is a federal program. And what it does is it allows investors to sell off into the open market approximately 39% of the investment that they're going to make at a location. So let's say you're making a $10 million investment. So in theory, $3.9 million can be recovered on the sale of new market tax credits. Um, how does that actually work? So you sell those items off, you're per the working rules, they're going to be sold off over a period of years, 7 to be exact. And so what you can do is you can sell those off, and instead of doing it every 7 years, you can sell the potential to someone else to sell that off so that you can capture all of that in your first year. Um, Between the financial consultants to set that up, your attorneys, as well as your accountants, you typically wind up being able to net 10 to 20% of that investment. So again, on a $10 million investment, you're probably looking at $1.5 million being returned to your project over the lifetime of that investment. So it's a great way to recapitalize. There's no guarantee that you're going to get the new market tax credit. You have to work with a company that has the allocation. Your project has to be a little bit what I would call sexy. Under previous administrations, they really wanted to work with green projects. The new administration hasn't come out with what they're interested in funding, and so we'll learn that as we head towards this year's allotments, which will be we'll learn more in September and October. All right, so the Texas Enterprise Zone. This is another program that's very easy to get access to here in the state of Texas on our property. I should point out that many times you have to have a property designated as an enterprise zone. TexAmericas Center is pre-designated as an enterprise zone, so we don't have to go through that process of making sure our property is eligible. So all you have to do is file the paperwork. You'll work with our organization and the county to be able to access this. So an example here might be that you have a $10 million new construction building, and there'll be about $500,000 of state and sales tax on construction and material. What you'll do is you'll apply for a refund on those specific expenses. The larger your project, the larger your potential amount of funds that can come back to you. I think there's 5 separate layers of the enterprise zone, from everywhere from a normal to, I think they call it a mega project. And each one of those, you can get a different maximum number. It starts with about $2,500 per employee, all the way up to the largest, which is about $7,500 per employee that can come back. And then they also calculate it on what the amount of your amount of expenditures that you're going to have going in. Moving over, this one is kind of interesting. It's newer. We've now have 2 companies that offer PACE financing programs in Bowie County. So what it does, it allows you to get 100% financing on eligible expenses. And it kind of works like a TIF district. And if you're not familiar what a TIF district is, a TIF district designates a specific geographic area, and it says that it caps the value of that ground and building at X. As you do the improvements, the assumption is that it becomes worth more. So that new increment becomes eligible to help finance the projects that you're going to do there. So you're kind of betting on the come, but it works out really well. So it's the same thing. If you're going to be making investments in any kind of energy equipment that uses energy, and you can demonstrate that there is a lower brand that it would take more energy to operate, and you're using a brand above that operates at a higher efficiency, it becomes eligible for PACE financing. The program really is set up to work with existing structures. However, once you've built the first structure on your property, you have an existing building, and so then you can go back and look at using PACE to use it as a financing mechanism for follow-up activities. You'll see down below under eligible upgrades, some of those are tied to HVAC, solar, renewables, water conservation, roofing, and really anything that encloses the structure. So this is all tied back to your property taxes. So as you pay your property taxes, you are paying off this loan that you made over, up to probably about 20 years. It would be a reasonable time frame to expect it to be set up, but you can go longer if you can negotiate it, and if your company has the strength to convince everyone that maybe it should be a 25 or 30-year loan lifetime. But PACE is an interesting way to pull components out of your project and get longer term financing on it. All right, so the final one is Freeport and goods in transit. So the state of Texas actually assesses a tax over your inventory. And some communities do not have any tax on that because they've passed a Freeport tax exemption. Some communities have the ability to allow a third party to handle your inventory, and you don't have to pay inventory taxes on that. And that is the goods in transit program. So in the case of TexAmericas Center, we currently do not have any of the taxing bodies that have agreed to the Freeport, but nearly all of the taxing bodies over top of TexAmericas Center have agreed to goods in transit. So if you bring in your own third party logistics provider, or you use TexAmericas Center, which has a 3PL division, is a way to avoid paying taxes on the inventory that you'll hold. Now, you have to keep in mind that there are some caveats in the program that differentiate it, and primarily being that there's 175 days where if the goods are in Texas over 175 days, you still have to pay the inventory. The other is if you ship within Texas, so you're holding them here, coming from out of state, and then you're going to ship to Austin, you still have to pay it because the goods are staying in Texas for a longer period of time. But for goods that are going to be shipped out of Texas, it's an ideal way to avoid the inventory tax. One of the things I do want to bring up is that because TexAmericas Center is not inside of a municipality, we have 100% property tax abatement on the inventory tax for municipalities because we're not in a municipality for that inventory to be taxed. So that is one of the benefits of operating here. To learn more about all the incentives that you're eligible to gain access to, you can go to our website and find our incentive summary under the region page, go down to at a glance, and then look for this document. Courtney on our team spends a lot of time making sure that this document stays up to date. Appreciate your help. If you notice something that has changed and anything, let us know, and we'll make sure we'll update it for the next person to review. Hopefully I didn't run over my time, and I'll throw it back to Andrew and Kim.
All right, we're gonna move right on ahead. Really have noticed that Mr. Joseph, thank you for coming on as well to this particular webinar. We wanted to recognize you because we had already done introductions, but I will go ahead and turn it over to Kim Lochridge with Engineered Tax Services. And if I hadn't mentioned to you, Mr. Joseph, who I am, I'm Andrew Hill. I'm the Vice President of Finance here at TexAmericas Center.
Nice to meet you.
All right, everyone. Thank you so much for joining. It's good to talk with you today. So I'm going to be talking about cost segregation, and this is directly related to the facilities or buildings that you're putting into service or that you actually currently own. I'll do a screen share here so that we can get the slides going. Can you guys see my screen okay?
Absolutely.
Awesome. Okay. Fantastic. All right. So we're going to just kind of briefly talk about this. This is going to take up kind of the next, 60 minutes or maybe 50 minutes so that we can leave some room for questions. Do you guys want to pause? Do you have questions for Eric before we jump into this other phase?
I actually did have a question, and I can give I wasn't sure because I missed I'm 5 minutes late if there were questions for the end, or you want me to ask the questions as we go?
Yeah, I mean, mine is a totally different topic. So I mean, it's up to you guys. Andrew, do you want to do questions now, or do you want to do questions at the end after both presentations?
Yeah, Mr. Joseph, go ahead and ask your question of Eric.
Okay. Yeah, thank you. Just some background. So I'm the North America CFO for Coim USA. So we recently acquired property within New Boston, and we're going to be investing over the next 18 months a significant amount of money to manufacture polyurethanes. So building blocks of things that go into spray foam or insulation foam, rigid board foam. And so I've on my list, Texas Enterprise Zone, the question I have, because obviously when we're spending all this money, the materials would have sales tax on them. So my question is that application account based on the calendar year, or is it project based? And then how do you, because I looked into this, each category is 1.25 million, up to 1.25 million. And my question is, those categories, how does that work, right? Is it 3 different categories, or can I take my investment and apply all at once to get the full 3.75?
So if I miss a part of that, bring it back up. But you had asked about does it work annually? Actually, these are awarded on a per project basis. We can have a total of 6 in the enterprise zone before we can have no further enterprise zones. Currently, we have all 6 available. And so once you register, it runs the length of your project.
Okay.
I think your second question then, can you repeat it one more time? Just make sure I'm.
So I think that answers my second question, but I have a new question. So my new question is, how do we start that process? Because
Oh, okay. So we would do that offline. Email
Yes,
me,
okay.
and we need to coordinate that with the county. And whether I do it or our CEO does it, our CEO normally is the one that interacts with all the legislative bodies in the area. And I stay forward facing, working with companies. But right now he is inundated with activities relative to the Red River Army Depot. And so he may ask me to handle that, but I need to determine from him how he would want to handle getting you registered and getting that all set up. The other is, and we do this all the time, sir. So if any of these incentives you want to speak directly with the coordinator at the state level, we'll set up that meeting. We'll want to get your project listed with the state. We were using Project Arnold 2 when the company you bought, Palmer, was looking at doing this expansion. So we can either keep it Arnold 2 or we can change it to a new name. It doesn't matter, but we'll get you registered with the state, and then they'll issue a finding in terms of what they can bring to the table in terms of incentives. Most of the ones that you'll be eligible for are going to be administrative, things like the enterprise zone where you just apply for it. Because I did see that you had already made the announcement that you bought the company and were planning on making the investment. So if you were wanting to go after anything like the enterprise fund, which is a competitive, the way it was announced probably negates your ability to pursue a check from the state of Texas.
Got it.
Eric, this is Jordan. I got a quick question. Are you going to be able to forward us your PowerPoint presentation?
Yeah, if anybody would like it, we'd be happy to do that.
Okay, great. Thank you.
But please look at that incentive document. That is everything that's available on our footprint, and we can send that to you as well.
Okay.
Kim, did you start to say something?
I was just going to say, I think that it's also being recorded, so the transcript can be sent over to you as well.
Yeah, I was just fixing to say that same thing, Theo. Thank you. Thank you.
And Eric, if you're able to share your email, please.
Yes, sir. We'll get that to you. You want it now?
Later's fine.
Okay.
Thank you.
Or maybe you can just drop it in the chat too.
Oh, yeah. Melanie, would you do that, please?
All right, Kim, it's best back in your hands. We appreciate your patience and you allowing the questions right in the middle. Thank you.
Yeah, no, I think it's important, especially switching topics, to be able to leave room for those questions and make it relevant so that we don't forget what those questions are, and that they can be addressed appropriately. So we're going to chat about cost segregation. This is probably one of the most underutilized tax incentives for anyone who owns real estate or property. This has been something that a lot of people will put their head in the sand regarding this and say, if this was something that was meant for me, my CPA would have told me about it. And it's just not one of those things that we see widely being utilized as much as it should be. So I'd say maybe 20% of the CPAs are utilizing this on a regular basis, and about 80% are missing it. So we're going to chat a little bit about CostSeg. I'm the Executive Vice President of Engineered Tax Services. Our company has been around since 2001, so we're in our 24th year. I have been there for 16 going on 17 years, and I have been a real estate investor since the late 90s. So I have a nice portfolio. I'm on the Tax and Sustainability Committee for the Real Estate Roundtable in Washington, D.C. That group, the Real Estate Roundtable, is the largest lobbying group in the country for real estate. And collectively, the members of that group own 72% of all real estate in the United States. So we have very large family offices and REITs and those types of companies representing on that membership. A lobby table. And then again, I'm on the tax and the sustainability committee for them. I'm also a multiple board position holder, and then I speak multinationally in regards to U.S. tax incentives. So without further ado, we'll kind of move forward a little bit about engineered tax services. We are a specialty tax firm. So we focus on those specialty tax products that need an element of engineering, hence where we marry the principles of engineering with tax and accounting. We do cost segregation studies, 45L 179D energy certifications. We also do research and development tax credits. So I think that, David, for you with the business that you're doing, I think we should have a conversation about substantiating some of that research and development that would come along with what your new venture is. And we also have a commercial P&C insurance brokerage, so we can help with, challenging with insurance being, pretty much increasing about 300% over the last year or two. So we can assist with those as well. We have our engineers strategically located around the country so that we can be at any property within a couple of hours. So we have multiple offices, 20 plus offices, and we have our engineers, as mentioned, strategically located. And then we don't have to pay travel expenses. And most of the items that we do have to have an in-person site visit of sort or certification. And so therefore we cut down our costs by doing it locally. So we have local engineers. And we have saved billions in taxes for our clients. We run somewhere between 400 and 600 studies a month across the country. That's usually real estate. And then we're on the R&D coalition as well. So let's just chat a high level what cost segregation is. And then we can discuss about kind of how this is missed. Essentially when you buy a building, commercial buildings are put on a 39-year class life. I would say 80% of the CPAs will put the entire building on a 39-year class life. In that. And in this particular presentation, we're not going to talk about multifamily or residential. It sounds like we're more commercial based. So we're going to talk more on the 39-year class life rather than 27 and a half, but just know that those actually are interchangeable depending on the asset type. A cost segregation study is a process to evaluate the investment or income producing property to identify and reallocate assets from that 1250 property and reallocate them to 1245 property. Now, don't be mistaken when it says personal property. This does not now then also make it eligible for county taxes or property taxes. This is a completely different bucket. It's 1245 property, not your FF&E, which are two completely different buckets. So as we shift those assets from the 1250 into the 1245, we actually shift that and we give it a new class life. So you're not depreciating the asset over 39 years, of which nothing in that building is going to last 39 years. Okay. So what we do is we shift those into buckets of either 5, 7, or 15 year. I throw 7-year in there because it is a part of manufacturing and equipment. So we can put those into those buckets. I think everybody knows that equipment is usually put into a 7-year asset, but what people miss is that some of the electrical, the mechanical, and plumbing that service those those manufacturing equipments actually also get to go in a 5-year bucket because of their purpose. This is where CPAs miss it. They are not able to identify the mechanical, the electrical, and plumbing within a property to shift it into that 5 or 7-year bucket. Therefore, it's left in a 39-year and you're losing out on the depreciation. So, so this is essentially going to be something that we're going to be discussing through this, and this process will build this slide deck, or the presentation is going to build on itself and talk about some of the ins and outs and the reasons why this is so important. So here's just a visual, essentially, instead of depreciating the entire building that's either purchased or constructed over 39 years, we're going to be compartmentalizing and itemizing those assets. We're going to be shifting them, as mentioned, into 5, 7, and or 15 years. And this could consist of the lighting, gas distribution, fire protection. We break down all the different units of property. We take the specialty lighting or the equipment. We take the flooring, the cabinetry, if anything, the landscaping, and we move those over into their appropriate buckets in accordance with the IRS regulations. Again, CPAs typically don't do this because they're not engineers. They cannot identify the mechanical, the electrical, and plumbing and what goes where. That's not their job. So essentially, they just put it in and they throw it on this 39-year class life. Okay, so that's just a quick visual. Now, when does the cost segregation or makers methodology apply? When we get into this, this could be newly built structures where we can apply those and we can break down all of the different components inside and outside the building. So newly built structures would be something that we really want to apply this to. And, sometimes, your contractor will give you the AIA breakdown of the costs. And the problem is that they can't differentiate. The contractors can identify the assets, but they can't identify the class life that it belongs in because they don't understand tax. On the other side, the CPAs can identify the building class lives in many cases, but they can't break down the engineering. Hence, where engineered tax services comes in, and we marry those principles between engineering and tax and accounting. Okay, and so our engineers will go into that property, identify all of the costs, break out those specialty equipment or the assets that service those equipments, and we put them into the proper class lives. Therefore, also giving you a clear cost breakdown for every asset in those buckets. Now, remodeling projects or CapEx or any kind of improvement that you're doing to a building is also a great opportunity to do these. It gets deeper with remodel projects, and we'll get into later in the slides the partial asset disposition, which is just a hugely beneficial incentive, and we want to make sure that everybody is capturing that. Current properties. So let's say you have, 10 buildings that you've had, in the past, and you've done them on the straight line depreciation. We can still go back to do a cost segregation study, break out the assets, and bring those tax deductions forward into the current tax year without having to file an amended return. This is important for companies because we can capture those deductions that maybe the buildings have been put in place for maybe 5, even 10 years. We can still go back and break down those assets and bring those forward utilizing a change of accounting method, which is an automatic change. So the IRS just hands us this tool to be able to implement these changes ongoing. So we can go back to previously put into service buildings. Recent acquisitions. So if you purchase a building, that would be a great opportunity to do a cost seg study. We're going to go in and recreate and essentially provide a Bible for that building. Everything is going to be broken out in detail. We're going to give you an Excel spreadsheet so that when you're ongoing and you're doing any other improvements throughout the years, those improvements are and then documented, and then you can really create this living, breathing document that consists with ongoing tax deductions for those properties. Anytime we do improvements or leasehold, improvements that you don't even have to own the building. Let's say you're leasing the building, but you're putting in an extravagant amount of improvements. Perhaps that facility is in California. A lot of times CPAs will pop that into a 15-year maybe QIP bucket, a qualified improvement property bucket, which would be depreciated over 15 years. But when we go in and do a cost seg on that, we can carve out 5 and 7-year property. Therefore, it actually saves more in your state tax because the bonus depreciation is not recognized by a lot of states. So this could be a tax deduction at the federal and the state level, quite substantially. Anytime you have projects that are sustainable or energy sustainable lead incentives, we can apply cost segregation. Anytime there's a basis step up, if there's a partner that is bought out, or if there's an inheritance or something that happens and there's a basis step up, we can apply the cost segregation results to those basis calculations. 1031 exchanges was another option. So if you're doing a 1031 exchange from one property into another, that's a great time on the excess basis to apply the cost segregation benefits. So here's some examples of tangible property, and this is actually just a smaller property. We don't have to spend too much time on it, but examples of tangible property would be just, this is just an example, say a chandelier or specialty lighting you might have, and this would go with manufacturing facilities as well. So if you have specialty electrical in there that's driving some of those mechanical or manufacturing equipment, not just the cost of the equipment goes into the 7-year bucket, but also all the electrical that feeds that machinery all the way back to the breaker box also goes into the same respective bucket. The problem is, again, CPAs can't identify how much lineal footage it is for those electrical wires to go back to the breaker box. That's where the engineers come into play. So in something like this, you have specialty like fans, or you have the molding, or you actually have, the pendant lights as an example. This could be track lighting. This could be anything in a showroom, depending on, it's very different for so many different properties. But this is just a quick example to push that home. And then let me give some examples of the power of this. The power of this, and this is just essentially a $2.5 million purchase. And I'll go through this slide because I know there's a lot of information here. But essentially the old rules without bonus depreciation, and this is the standard way that most CPAs, the 80% of CPAs are doing the deduction. You're essentially putting the $2.5 million basis on a straight line depreciation. It's being depreciated over 39 years. This is my example. Basically, every year your depreciation is going to be $64,000. Okay, sorry. So that is your first stage, what 80% of the CPAs are doing with your straight line depreciation. Okay, so now we move over to doing a cost segregation study, and we shift it to the maker methodology where we're actually carving out the different buckets. Now you can start to see with this particular opportunity, we have a shift of about 24% of that basis was put into a 5-year bucket. That would be all of those mechanical, electrical, plumbing things inside the property. That would yield a bucket of about $600,000 of that going over the course of 5 years instead of 39. So this is designed. The IRS allows us to put these assets in those faster buckets because they realize and recognize that those assets aren't going to last any longer than that. So we put those in the 5-year or 7-year bucket in accordance with the tax rules. Now, 15-year property is reserved for exterior of the building. So landscaping, irrigation, parking lots, covers. I'm in Arizona. We have a lot of covered parking, and then most of them are turned into solar panels, right? So there's all kinds of things like that you can do. Signage outside the building. All of that outside the building should be carved out and put into a 15-year bucket. In this case, on average, we see a shift or a reallocation of about 30% of that original basis, in this case, which is 2.5 in our example that we're using. So essentially, there's another $150,000 that we can carve out that would get depreciated over its respective 15-year bucket. So now you have a 5-year bucket and you have a 15-year bucket, and the remainder, 70% of that building, the 1.75, is still depreciated over 39 years. The power of just doing the cost segregation without any of the bonus depreciation, which we'll get into, is that now your deductions are going to be about $172,000 the first year. And that is a double declining balance, whether it's 150 to 200 between the 5 and 15-year property. But 172,000 is a far cry from 64. So you're about doubling your benefits or your depreciation simply by categorizing these assets. And again, it's only 30% that we're reclassifying, okay? So we're reclassifying about 30% into these buckets. You're essentially getting about 172,000 in deductions. And with these larger properties, it just gets exponentially bigger, okay? So mind you, we're just talking about a $2.5 million basis here. Now let's talk about bonus depreciation. So the bonus depreciation began, actually it started in 2006. A lot of people, that surprises them because they weren't really paying attention to it and it wasn't keyed into that, but it was really only reserved for new construction, and it was 50%. In 2017, we had the Tax Cuts and Jobs Act, which we passed that bill and was able to get the 100% bonus depreciation. We went from 50 to 100, and we expanded it to include used property. So I have another slide with the dates on that, and we'll talk about kind of how those got implemented. But this is where it becomes even more powerful. When you have 100% bonus depreciation, you now have the ability, essentially what's happening, we're still reallocating it. We're still doing a cost seg study and reallocating all the assets. It's still 30%, right? But what happens now is that 100% bonus depreciation goes in on any assets in a bucket that is 20 years or less, which includes our 5 and 15 year that we identified in our cost seg study. Those now get shifted into those buckets that are 20 years or less. Bonus depreciation applies to those buckets. So in our 5 and 15 year buckets, essentially what the bonus depreciation is saying is, you know what? You don't have to wait 5 or 15 years for these deductions. You get the deductions all 100% right now. So instead of allocating the 600,000 over 5 years and the 150,000 over 15 years, with the 100% bonus depreciation, you get to take the 750,000 right now, right off the top. So you're getting an advance essentially on that depreciation, which really minimizes those tax deductions. Now, what's going to happen is the rest of that 39-year asset, you're still depreciating that same 70% over the 39-year bucket. So you still have depreciation. So don't think that you're taking all of it up front. You're just getting this massive tax deduction to help you with those revenues. And if you can't use it all, it simply just rolls over to next year and offsets your income. Okay, so powerful, powerful move. In comparison, instead of taking $64,000 in depreciation a year, you're taking about $800,000, all right, when you're eligible for the 100% bonus. Now, we have a bonus depreciation slide, and I'll talk about that momentarily. Let me just make a note to myself. Okay, so moving on to the next slide. This is just a little bit depiction of what I'm talking about. A lot of people think that if you this blue line here is straight line depreciation. A lot of people think that, oh, if I'm going to do a cost six, I'm going to take all this depreciation up front, like we were talking about the 700,000 or 800,000. I'm not going to have any depreciation in coming years. That is hogwash. And it is a myth in the industry. A lot of people think I'm taking all my bonus. I'm not going to have any other depreciation going forward. This slide will prove that essentially what's happening is you're getting a big deduction up front, yes, and then you actually depreciate it. But the rest of the depreciation in future years just falls a little bit below the line. So in that other case, instead of depreciating 64,000 a year, you might be depreciating 50,000 a year, but you're still got that $800,000 up front. Okay, so it's a very, very, very powerful move, especially when you have assets of a large caliber. Okay, so don't think for 2 seconds that you're depreciating all of your building. That really only happens with special asset classes.
Kim, can I ask a question? Yes,
please.
So, how many years forward can you carry that? Is it traditionally it's like 5 year? Is that what you're talking about? That you can, if you can't use it all in the first year, you've got 4 more years after that to be able to use it?
Yeah, actually, it's you can roll forward indefinitely. There's no limit. So as long as you still own that building, you can keep carrying that forward. So if you're taking a $5 million tax deduction, and we haven't even talked about partial asset disposition yet, which is a whole nother element to this. Right now we're setting the foundation of what cost segregation is. Now we're going to start building into talking about how to use it in ongoing years and how it's a report that will pay you back consistently. But in a response to your question, it is an indefinite carry forward as long as you own that property. And if you have those losses banked up and then you sell the property, it just converts it to ordinary. So it's very, very powerful.
Thank you.
Yeah, thank you for your question, Eric. Okay, so here's the slide about the bonus depreciation. Okay, so essentially, again, the 100% bonus depreciation started for September 27th of 2017 through January 21st of 2023. We had the 100% bonus. This was part of the Tax Cuts and Jobs Act. This is applied, bonus depreciation is applied to any property with a useful life of 20 years or less. So when you have those 5 and 15-year buckets, this is what bonus depreciation applies to. It does not apply to your 39-year or long-term asset. That's why we extracted those from those previous slides. Now, this constitutes for used property and not just, first implementation. So it's not just new construction anymore. You can actually buy a property or have had a property that you've purchased since 2017, and you can still go back. You can go back as many years as you want to. It's just the bonus depreciation that is limited for those years. Now, it's important to note that in the Tax Cuts and Jobs Act, when we were developing and consulting on this through the Real Estate Roundtable, I've been involved in the CARES Act and the America Workers and Families Act, the Tax Cuts and Jobs Act, and many, many others. But when this Tax Cuts and Jobs Act was being written, we were influencing them in regards to the bonus depreciation. They had to have it sunset in order to get the bill passed. So these dates up here, 2017 through 2022, we get the 100% bonus. Now, what that means is it starts to sunset. Now, the bonus depreciation is triggered by the placed in service date, not when you do the cost seg study. So if you had a building that you put into service in 2021, you are still eligible for the 100% bonus depreciation retroactively. And again, you do not have to file an amended return to get it. Okay, so that's very important to note. We can go back to those properties, hence what I was mentioning about the existing properties. All right. Now in 2023, that bonus depreciation drops to 80%. All that means is that everything that we reclassified into the 5 and 15-year buckets, now 80% of that $750,000 that we were talking about in our example, 80% of that would go in a first-year bucket. The remainder goes, the other 20% spreads out between its respective 5 and 15-year buckets. So you're still getting that accelerated depreciation. You're just not getting all of it up front. You're only getting 80% up front. Okay. 2024, placed in service date, you get 60% of it up front. The other 40% gets allocated over its respective buckets. Same thing with 2025. So this year we have 40% bonus. The other 60% gets reallocated. You're still getting a benefit there. 40% is better than nothing, but it's starting to sunset. Now, the important thing here is that currently we have this budget reconciliation that has already passed the House. In that budget reconciliation, we have bonus depreciation being reset to 100%. If that bill passes, so pay attention to that bill, if that bill passes, we have the ability to now apply the 100% on properties that were placed in service in 2025 and forward. Now, we're not sure if this is going to be indefinite, although that has been some discussion, or maybe it's a 2-year benefit where we'll have it for 25 and 26 and then it's gone. We don't know what the Senate is going to do when they revise it. We're still waiting on pins and needles. We anticipate that we're going to have the budget reconciliation ready for the president's signature as soon as Senate passes it with all of their changes by July 4th. Okay, so very, very soon. So right now we are hoping and believing that we will get that 100% bonus depreciation back for 2025 and 26 tax years. Okay, so keep an eye on that bill because I think it's going to be hugely important, and it's also going to create some really nice tax strategy opportunities for anyone going forward. Okay. Here's just a small case study. The case study is just another example. This one's a $500,000 purchase, very small building, right? So we pull out the land. Land is not depreciable. We're left with a building basis. That net basis is what we apply our cost segregation to. You can exponentially put this in. You can add zeros to the end of it, and it will just exemplify the example. But essentially, we, in this particular case, we're estimating that we would shift quite a bit of it on this particular property. This is a manufacturing facility. 40% of it actually, or 42, went into a 5 and 7-year bucket. So in this particular case, it was a huge benefit. Another 24% was allocated in 15. Now, this is indicative of a specific property type. So it's the inversion of the other example where I showed you 30% would get allocated to faster buckets. In this case, 64% was reallocated into faster buckets, and only 34% was left in a 39-year asset. So on those big manufacturing facilities, maybe medical office space is a good example. Self-storage is a good example. These property types actually perform a little bit better. So you just never know. And that's one of the reasons why the IRS does require the cost segregation study, so that you can identify those assets and correctly put them into the appropriate buckets. So in this example, even with just a $500,000 purchase, they're still able to deduct about $275,000. That's just huge. In comparison to that, had they not done a cost seg study, their depreciation would have been $9,200 the first year. Okay, so the big difference, and the power of tax planning to be able to use these numbers instead of just your straight line depreciation is massive. Okay. Again, we don't have to amend the return. So this is something that we, are vocal about. A lot of people think, I don't want to do a cost seg study. I don't want to go back and recast or amend my tax returns. The IRS gives us the change of accounting method, which is a tool. We do a 481A adjustment, which is a reconciliation between the old depreciation that you've already taken in straight line and the new depreciation that we found in the cost segregation. That 481A adjustment is the reconciliation between the old and new. That's what gets reported on this form 3115. So the 3115 is the actual tax form that we report that on. That gets filed with the return. You don't have to amend taxes. Okay, so it's very powerful. There is no limit on the look back. You can go back 15, 20 years and get a cost segregation study done, bring those deductions into the current tax year. So if you've never utilized cost segregation before, and now you're interested in properties that you've already had, we can go back to get those, and we can do it in a year that you might have a big, liquidity event or some sort of, a buyout or a capital gain or something, that we can apply those deductions strategically to the year that actually makes sense for you. Okay. So again, this is an automatic change by the IRS. You don't have to have approval. This is something that give us the tool. It is simply just like the difference between shifting from a cash basis to an accrual basis, and there's an adjustment. It's as simple as that, and that's how the IRS looks at it. So it's a very, very powerful tool, once again. Okay, so what happens upon the sale? Let's say you accelerate the depreciation and then you sell your building. Okay, so if you're in this 5 or 7 year bucket, you will have some recapture to pay. But there are some very interesting ways to get around recapture, but also there's ways within the opportunity while you own it to minimize that recapture. And we'll talk about the partial asset disposition and kind of what that is next. But essentially, when you sell the building, there will be some recapture to pay on the accelerated depreciation, but it does offset the income. It secondarily reduces your tax, obviously, because of the result. And essentially, that's going to help offset any of the gain or the income that you have. Now, you can avoid the recapture if you do a 1031 exchange. That is something that it has been around for decades. And so you can avoid that. A lot of companies don't really want to do a 1031 exchange, and that's fine. But you could do what's called a lazy 1031 exchange. That is an option too. And we won't really get into that, but that is an option. If you're working with us, we can actually talk through some of these things. And then if somebody is going to just exchange that property, if you're a real estate investor like myself, you want to get out of the property, you can actually go into a DST, a Delaware Statutory Trust. If you're going to pass it to heirs, there's all kinds of incentives doing that. And then, of course, there's opportunity zone funds, which I know Eric and Andrew are very familiar with. So there's just so many options to reduce or minimize or even eliminate that recapture. So that's another myth. I think it was about 12 years ago, I wrote an article that was published in Accounting Today that is still circulating quite heavily about the myths of cost segregation and debunking those myths. And one of the myths is that, you don't want to take your depreciation up front because you're just going to have to pay it all back. It's just such a different mindset. So we really have to get out of mindset of thinking that way. Okay, let's get creative on how we can use this going forward. Now, one other thing I want to point out. With very large buildings, anywhere where you have a potential gain of about $5 million or more, that gain, we can do a cost seg study initially. And then let's say you're going to sell it in year 7. We can go back if you anticipate a $5 million or more. Well, I would say about $2.5 million or more gain. We can actually go back now after you've utilized all those deductions, and we can do a reverse cost segregation study, undo what depreciation has not yet been taken, also the recapture on the backside. So that it's called a sale allocation study. I have a ton of clients that will hold a building for, say, 5 years. They'll do the cost segregation study. They'll take all the upfront benefit. In year 5, a lot of those assets are already now fully depreciated or completely depleted. And so we can actually do the partial asset disposition before they sell and minimize the recapture. So there's just, like I said, a ton of ways to minimize the recapture on the backside. That's what we do. We kind of help strategically plan with our clients to identify those and then also minimize it before the sale. So let's talk about the partial asset disposition. Okay, so in this particular case, Treasury Reg is at the top there about what the partial asset disposition is. This is the number one thing that is underutilized in cost segregation and real estate ownership. Okay, the partial asset disposition is missed probably 95 to 100% of the time. It is uncanny how much the CPAs are not utilizing this tool. So the partial asset disposition was introduced in 2011 with our tangible property regs, which I was also very involved in. This is a tool. Okay, so I'm going to give it to you in layman's terms. Think you buy or you build a property. All right. Let's just say you buy a property and then you're doing some improvements. It's a little bit easier to ascertain. So you buy a property, and let's say for a roof is an example. Okay, you buy the property, it has a roof. You've identified that roof, and essentially in year 5, you have to replace that roof. Let's say that roof is $1 million. Okay, you spend $1 million, the IRS requires that we capitalize that roof. So now what's happening is you have your roof in the original purchase, which you're depreciating over 39 years. You now put a new roof on for $1 million and it has to be capitalized. Okay, now you're depreciating 2 roofs. Now you're accumulating depreciation on 2 roofs. The partial asset disposition tool is designed to be used so that we can take the remaining depreciation of the old roof that was removed, get it off those books, and take a 34-year deduction of the remaining depreciation of that initial first roof. Okay? You cannot dispose of the asset unless it has been identified and documented. So the CPAs that do the straight line depreciation, they do the whole building, right? That whole building, like in the first picture that I showed you, the whole building's being depreciated over 39 years. You replace the roof. They don't know how much the value of that initial roof was, so how can they dispose of it? So it stays on the books, and you continue to appreciate 2 roofs and sometimes 3 roofs over the course of 20, 30 years. We want to be able to take that old roof off. It is allowable only in the year that the loss happened, or the year that the removal was taken. So let's say you buy the building in 2020. You depreciate that building for 5 years. It's a 39-year asset. In year 5, you put on a new roof. You have 34 years left of depreciation on this first roof. When you have a cost segregation study, we are identifying not only that roof, but all the different levels of that roof. So we can go in and say the moisture protection was actually removed, and the outer layer was removed, and we take off those layers. We then now have, remember when I said we're producing a Bible for that building? We now have the backup documentation, and your CPA can calculate that partial asset disposition for the roof that is being removed. And now you get to take a deduction, even though you have to capitalize that roof and now put that on a depreciation schedule for another 39 years. But you're taking the deduction off of those books, and therefore no more accumulated depreciation is being accrued. So it's a very powerful tool by having the cost seg study done. That way, any improvements that you're doing on this building, as long as you own it, now have the ability to take that partial asset disposition. So any improvement, especially the structural, you're replacing windows, you're doing an addition, maybe you're taking out a whole section of that building, maybe you're reconstructing, and repurposing an area. All of those things that are removed in that improvement process or renovation process is now eligible for the partial asset disposition. If you miss the partial asset disposition, you miss it forever. So let's say in 2025, you don't take your partial asset disposition because you didn't get a cost seg study done and your CPA missed it. Very, very normal. You'll see the building depreciation schedule. You'll see an improvement. And unfortunately, there's nothing we can do. We cannot go back retroactively and take the partial asset disposition. So you're stuck depreciating both roofs into perpetuity as long as you own that building. Okay, so the power of the partial asset disposition is way farther than even the cost segregation study. So you do the cost segregation first, you get this really big tax deduction because of the bonus depreciation. Then ongoing, this is a report that will pay you back year over year as long as you own that building because of the partial asset disposition on any improvements that you are doing in the future. So a very, very powerful. And don't forget that as you do those improvements, make sure that you have that cost segregation study done, because you have to take that partial asset disposition in the year of the disposal. You cannot come back retroactively and do it in a separate tax year. So if you remove those assets, say in 2024 and you're on extension, you can take the partial asset disposition. If you remove those assets in 2024 and then you found out about it in 25 for your taxes, too late. You're stuck with it forever. Okay? So extremely important. Do not put your head in the sand and think that your CPA is doing this for you. Take matters into your own hands and ensure that this is happening. Okay. Now, we can talk about income expenses, active and passive losses, all those types of things. But if you're a business, and it sounds to me that both, David and Jordan, who are on the call today, you guys are doing this from a corporate standpoint. You don't have to worry about passive or active. These deductions, typically the building should be held in an LLC separate from the business. Then the business rents that from the LLC building entity owner, and then essentially it's a common ownership, and those just flow through and offset the income from the property to the property owner. So we don't need to get into the inner workings of the active versus passive, because this should just qualify. But there would be some limitations if you're a real estate investor. It might be passive losses. All is not lost. You can still use the depreciation and the cost segregation benefits, but it is actually one of those things that we need to talk about if you're an investor. Okay. when is it a waste of money? When should you not do a cost seg? And we don't have to get into these, but if you're just doing a flip, and this is really more for real estate investors, it never really goes into service. So you're not going to do one on a flip or a wholesale deal. If you're going to hold a property for less than a year, it's not a flip, but you're only going to hold it for a short period, probably not advisable. If you're a nonprofit entity, obviously you're not paying tax, so you're not going to do a cost seg study because this is direct correlation to the ownership and the depreciation, right? Offsets the income. If you're owned it for more than 15 years, now this is an asterisk, right? I usually say let's go back 15 years because again, we're reclassifying assets into the 5 and 15-year buckets. But there is an exemption to that. If you have a large amount of income or a liquidity event, sometimes going back further than the 15 years makes a lot of sense for that person because maybe they have that liquidity event and they're trying to offset some of that income for that year. It can be used as a tax strategy and you can go back farther. Again, the IRS doesn't give us a look back limit. This is just my personal kind of rule of thumb. If it's more than 15 years, we probably don't want to do it unless it's for another reason. This probably doesn't apply. Improvements, if it's less than 200,000, we probably wouldn't do a cost seg study. And then here's the other thing that's very, very important to note, especially on larger properties. The IRS tells us that we must do a site visit, an in-person site visit by a third-party qualified building professional. There are cost segregation companies out there, and just be aware, make sure that you're educating yourself. If you're not going to use engineered tax services, which I hope you do, make sure that you're getting what you're supposed to be getting. If you do not have an in-person site visit, the IRS will throw it out. If the site visit is done by a photographer or an appraiser, they are not a qualified building professional. The IRS will just throw it out. They're not going to go and redo your cost seg for you. They're simply just going to disallow it. So the site visits by a qualified building professional, that could be an inspector, that could be a building, an engineer, it could be a professional engineer, and it could be like a contractor. We do the site visits in person and we do quantify that as a qualified building professional. So that's very, very important. If you're not going to have that done or a company tells you that you can get by without a site visit or with just a photographer, make sure that you're asking for the credentials of the person doing the site visit. We offer audit defense. So if you get audited, what happens is the IRS will send an IDR and ask for clarification. And what's very, very interesting, there has been an uptick in the auditors coming back in the IDRs and asking not only was there site visit, but they are asking not if there was a site visit, they are changing the terminology and they are saying, please provide us with the credentials of the person who did the site visit. Okay. So don't get caught with that question. Make sure that you are qualifying that whoever you use to do your cost seg study, hopefully ETS, but that will be somebody that is qualified and that you can proudly present those credentials to that auditor. Okay. Now I'm gonna leave you with a quote that I think is powerful. And it's kind of our motto here at Engineering Tax Services. We believe that everyone should pay tax, but there is nothing in the code that says you have to leave a tip. We are in the business to take the tip off the table. These are legal ways. This is one of the reasons why Trump didn't pay tax all those years. He's a real estate guy. He owns a lot of real estate. He does the cost segregation. He implements the bonus depreciation. And that essentially offsets your income to where you are minimizing or eliminating your tax legally. So this is something that we want to make sure that we're left with, that you don't just do your straight line depreciation on your facilities. Please make sure that you're reaching out to us and we're doing the cost seg studies and establishing that upfront or even retroactively to get those benefits for you. So again, I'm Kim Lochridge, Engineered Tax Services. This is my direct line, my email address if you want to reach out to me. If you want, we do complimentary benefit analysis for those properties. And usually our studies take about 6 weeks from start to finish, and we can implement those into your tax return. We work directly with your CPAs, and we will provide them with all the necessary documentation and handhold them throughout the process to implement this into your tax return. And thank you so much for your attention today. I'm open to answering any questions you might have.
Hey, Kim, I had one question. You mentioned on one of the slides about opportunity zones being able to help in case a person actually sold that particular property. And it is the benefit from opportunity zones, does that come from the fact that you're able to go ahead and divert your gains from any taxing?
Yeah, that would be gains and or potential recapture, right? So if you have any recapture to pay, you're essentially, you can do a 1031 exchange into an opportunity zone area, or you can simply just invest, take the capital gains and you can invest in that same tax year into an opportunity zone fund and then essentially offset the tax liability that you have on the gain.
So
Thank you.
I'll just mention TexAmericas Center is an opportunity zone area. We don't have a fund set up, but there are funds out there. The question that I had for you, it's kind of similar to the one that I asked before, Tim, but a lot of times you can take your depreciation and any kind of write-off, and you can look backwards as well. I'm assuming that's possible. A lot of small businesses are going to have that really good year that's giving them cash to allow them to go ahead and expand. And that year they're going to pay a lot of taxes. But once they have this new structure built, is it potential they can go back and amend and carry it back and recover some of the taxes they paid in previous years as well?
So a carryback is a little bit different than an amended. You can go back and amend a tax return if it's within 3 years, but you would have to, but you would have to have had the building placed in service within the 3 years. You can't go back and amend a tax return 3 years ago for a property that you've already put in service 5 years ago, for instance, right? Because of 3115, when we do the reconciliation, that form can only be filed on a current tax filing. So you would have to do a 3115 and bring it into the current tax year. So you can either amend if it's within the 3 years, or you can file the 3115 and bring it into the current tax year with those losses. We did have some carryback rules in I want to say CARES Act 2022, maybe. We did have the ability to carry back 2 years. So that means that you could file it, you can bring the 3115 and bring all your losses into the current tax year, and then you can actually carry them back and apply them to 2 previous tax years. But that has since expired. So we do not have a carryback option, only the amend option. So no carryback, but you can do that. And then also you can carry those forward just in the 3115 utilization.
Thank you.
Mm-hmm. And Jordan and David, have you guys talked to your CPAs about cost segregation? Are you currently utilizing this with any of your facilities?
You're muted, Jordan.
Sorry about that. As I indicated at the outset, we are not in the data center development business per se. So somebody else, our data center partner, is going to be constructing that building. They have their own professional advisors, of course. I mean, this is something, obviously, I can send your name and contact information on to them, but can't guarantee that they would have interest or that they would reach out to you. As far as the baseball or sports facilities we build, they end up being owned by the community. So I doubt that we are going to be in the position to take any of these incentives or depreciation deductions directly. That makes sense.
Does make sense. And the ones that are privately owned, like I know that we've done the Cleveland Browns Stadium. We also did the Denver Broncos Stadium. So some of them are privately owned. Raiders Stadium is another one. And we just got the Buffalo Bills Stadium as well. So there are some that are privately owned that we can do this on. So in those cases, it does make more sense. Yes.
You're quite correct, and you're certainly up to speed. The first ballpark I built was privately owned, but if I have a choice, I'm never going to go down that road again.
Don't blame you. Well, keep this in mind for any real estate that you all are doing. You know, I mean, it is a very powerful tool, and I would love to have any introduction that you might be able to send my way.
I appreciate that. And as I mentioned, if we have a choice and an opportunity, we would like to get into the mixed use development around the stadium, which is pretty
Yes.
popular in the sports world today. Some communities, we may have that opportunity. David Orr in Texarkana would like us to do something like that. So definitely I'll keep you in mind for that.
Yeah, thank you. I know one that comes to mind is the Glendale Stadium, Arizona. You know, I mean, they literally plopped that stadium out in the middle of absolute nowhere and then just built up around it. And it's been just an amazing, you know, phenomenon to watch that get built up. So very, very similar, I understand.
I lived for 12 years. I lived in Prescott, and I was around for all of that activity. So I echo your comments. They did a great job there.
They did.
I got to run for the next meeting I've got here, but I appreciate the time and effort everybody put into that, and thank you very much.
Thank you, Mr. Kobritz. And I want you to remember that this has been recorded too, if you guys need to look back and then review the information, because I know I'm going to go back over several things that I heard in this presentation. And I really appreciate Eric and Kim for coming on and being our experts for this particular presentation. If y'all have any questions, y'all can also call me over here. I think Melanie, she put my email address into the chat, so you can reach out to me directly if you have any questions about financing or other options that you might need in the building of your projects.
Okay. Again, thanks everybody. Stay well.
All righty. All right.
All right. Thank you. Very helpful.
Thank y'all. Thank y'all all for coming on.
Sounds good.
All righty. Thanks, Kim.